Welcome, everyone, and thank you for coming. Today, we are going to continue talking about savvy Social Security planning. In this presentation, we'll be focusing on more basic rules and strategies so you can find out what you need to know and know more. Because Social Security planning is such an individualized matter, you may have questions about your personal situation. I would be glad to meet with you and discuss the rules and strategies that pertain to you. So please make a note of any items that may apply to you personally, and we can discuss them later. In the meantime, let me acquaint you with basic rules 3, 4, 5, and 6 for Social Security claiming strategies. Okay, so let's get started. In our first presentation, we covered basic rule number 1. The first and most important thing to understand is that monthly benefits rise with claiming age. In other words, the longer you wait to file for Social Security, the higher your benefits will be. We also covered basic rule number 2. Your spouse may be able to get a benefit based on your earnings record. Today, we'll start with basic rule number 3. A divorced person may be able to get spousal benefits based on an ex-spouse's work record. The rules for divorcees are similar to the ones for married couples. There are a few additional restrictions, though. A person can receive Social Security based on an ex-spouse's work record, providing the marriage lasted at least 10 years and the divorced person claiming the benefit is currently unmarried. These are two key rules. It doesn't matter when the marriage and divorce took place. If the marriage lasted at least 10 years, even if the divorce occurred a long time ago, a divorced person may be able to claim Social Security based on that ex-spouse's work record. The person claiming the benefit must be currently unmarried. You could have had 2 or 3 marriages after the first one, but as long as those marriages ended and you are currently unmarried, you can claim a divorced spouse benefit. If you have more than one ex-spouse in the past, if the marriages each lasted 10 years or more, you can choose which spouse's record to claim benefits on. The order of the marriages and divorces doesn't matter. Other rules are that the ex-spouse must be at least 62. And if the divorce occurred more than 2 years ago, the ex-spouse doesn't need to have filed for his benefits. There are a few more things to know about divorced spouse benefits. First, more than one ex-spouse can receive benefits on the same worker's record. So if your ex-spouse has remarried a couple of times, all 3 exes can claim divorced spouse benefits as long as the marriage lasted at least 10 years. Johnny Carson, for example, was married 4 times. His first marriage to Jody lasted 14 years. His second marriage to Joanne lasted 9 years. His third marriage to Joanna lasted 13 years, and his fourth marriage to Alexis lasted 18 years. So Jody and Joanna could have each claimed divorced spouse benefits on his record because those marriages lasted more than 10 years. When he died in 1985, both Jody and Joanna could claim divorced spouse survivor benefits, and Alexis could claim a regular survivor benefit because she was still married to him when he died. His second wife, Joanne, was out of luck because that marriage lasted only 9 years. The benefits paid to one ex-spouse do not affect those paid to the worker, the current spouse, or the other ex-spouses. You do not need to know your ex-spouse's whereabouts, only enough identifying information that the Social Security people can look up his records. You'll also need to provide documentation showing the dates of the marriage and the divorce. If you are receiving divorced spouse benefits and you remarry, your divorced spouse benefits will stop. However, you may then be eligible for spousal benefits based on your new spouse's work record. Or you can switch to your own benefit, of course, if you also qualify for Social Security. Okay, so that covers divorce. Now let's move on to another important rule. Basic rule number 4. Now this is where things start to get a little less basic. Survivor benefits. We'll try not to get too lost in the weeds today, but survivor planning is essential, and there are a few things you should absolutely know. First, let's discuss who can get survivor benefits. In order for a surviving spouse to receive survivor benefits, the marriage must have lasted at least 9 months, except in the case of an accident. To start benefits, the survivor must be at least 60 or age 50 if they are disabled. However, if the widow or widower applies before full retirement age, the benefit will be reduced, as it is for regular retirement benefits. Some of the same principles that go into deciding when to apply for regular retirement benefits also apply to survivor benefits. If you remarry before age 60, you will not be able to receive a survivor benefit based on your previous spouse's earning records unless your remarriage ends. We've seen cases where a widow is contemplating remarriage in her late 50s. In those cases, we recommend a long engagement in order not to lose the survivor benefit from her first husband. If she remarries after age 60, she will still be able to get those survivor benefits. Divorced spouse survivor benefits are available if the marriage lasted at least 10 years. As we saw with Johnny Carson, 2 of his ex-wives could claim divorced spouse survivor benefits after his death because those marriages lasted more than 10 years. Survivor benefits are worth twice as much as spousal benefits. So it's 100% of the worker's PIA instead of 50% of the worker's PIA. If both spouses are receiving benefits and one spouse dies, the other spouse may switch to the higher benefit. Here's a hypothetical example. Let's say Joe and Julie are married. Both are over full retirement age and currently receiving Social Security benefits. Joe's benefit is $2,000 a month and Julie's benefit is $1,200 a month. If Joe dies, Julie's $1,200 benefit will stop and she will start receiving $2,000 a month. One important note about survivor planning is the loss of one benefit. Most widows and widowers need at least 2/3 of the amount of income they were receiving as a couple, so it is important to plan for the loss of one spouse's Social Security benefit. Even though it is often the higher benefit that will be retained, the death of a spouse means the loss of one Social Security check. And please note that if Joe had maximized his benefit by filing at age 70, say his benefit was $2,600 with the addition of delayed credits, Julie's survivor benefit would be $2,600 instead of $2,000. Without going into too much detail here, the main point I want to get across is that the amount of survivor benefits will depend on 2 things. The age at which the deceased spouse originally claimed his benefit, this determines the original benefit, and the age at which the widow claims the survivor benefit to determine the actual benefit. The widow will receive the highest income if the deceased spouse originally claimed his benefit at 70, and the widow claims the survivor benefit at full retirement age or later. Higher earning spouses who feel young and healthy often don't think about the survivor benefit when they are deciding to claim their own benefit. But as we saw with the examples of Bob and Betty and Mike and Mary, the survivor benefit can be significantly lower if the higher earning spouse claims his benefit early. Survivor planning is a very important part of savvy Social Security planning for married couples. It can really influence a surviving spouse's standard of living later in life based on the decisions you make now. It's really a customized process, so please come see me if you want help with this. What if you have already been widowed? Let's say your spouse died either before or after starting Social Security benefits. Or maybe you were married over 10 years, divorced, and your ex-spouse has died. Is there anything you can do to coordinate your survivor benefit with your own retirement benefit to maximize income and lifetime benefits? The answer is yes. You can sequence your benefits to the maximum advantage. You can start with one benefit and switch to the other one. The rule here is to always take the higher benefit last. If the survivor spouse benefit is higher, start your retirement benefit at age 62 and switch to your retirement benefit at full retirement age. If your retirement benefit is higher, start your survivor benefit as early as age 60 and switch to your retirement benefit at age 70. So let's look at an example. Here's an example of the widow Wanda. She is 60 years old now and has a PIA of $1,200 a month. Her husband died before claiming Social Security. His PIA was $2,600. Now, there are 2 things Wanda can do. 1, she can resist the temptation to start her reduced survivor benefit at 60 and hold out for the maximum by applying for it at age 66. When she turns 62, she can start her own reduced retirement benefit and then switch to the survivor benefit when she turns 66. Or she can go ahead and start her survivor benefit now at age 60. This might be the natural choice since the survivor benefit is higher and she wants to start income right away. But she may not realize that by claiming the survivor benefit now, it will be permanently reduced for life. $1,859 a month versus $2,600 a month. Which scenario do you think will give her the most benefit over her lifetime? As we can see, Wanda receives more lifetime benefit if she waits 2 years and claims her own benefit at 62 and switches to her maximum survivor benefit at 66. These claiming scenarios are not always intuitive. That's why we depend on calculators to show us what benefits would be over a lifetime based on the different claiming strategies. We've already talked about the disadvantages of early claiming in terms of the actuarial reduction. But there's another problem. One thing that might make early claiming totally moot. If you claim benefits before FRA or full retirement age and continue to work, your benefits will be withheld. This is called the earnings test. If you apply before you turn full retirement age and you earn more than $17,640 in 2019, $1 in benefits will be withheld for every $2 you earn over $17,640. Now, it's important to know that this money isn't truly taken away. Rather, your benefit will be adjusted upward when you turn full retirement age to make it as if you had applied later. This means that if some of your benefits are withheld due to the earnings test, your new benefit will be higher as if you had started at age 63 or 64 or 65 instead of at 62. This can actually be advantageous in the event that you file at 62 and regretted it. Please don't let the annual earnings test discourage you from working. The more money you earn, the more money you will have. Social Security does not penalize you for working. Once the adjustment is made, you will end up with a higher benefit for the rest of your life. And of course, the earnings themselves will contribute to your financial well-being. To avoid the earnings test entirely, just wait until you are full retirement age or later to apply for benefits. The earnings test applies to every kind of benefit: retirement, spousal, and survivor. It may even cause your spouse's benefit to be withheld. If John and Jane are 62 and Jane is getting a spousal benefit off John's record and John goes back to work, then Jane's spousal benefit will be withheld. And they are onto business owners who pay themselves a small salary in order to get around the earnings test. You may be subject to extra scrutiny. Let me just say that the earnings test is a hassle. You can skip it entirely by claiming Social Security after you turn full retirement age. Our last basic rule: Social Security benefits may be subject to income tax. The amount of tax you'll pay on your benefits depends on how much other income you have. We won't spend much time here because there isn't much to be done about this. Still, here's what you should know. This table shows the taxation of Social Security benefits based on the various income levels. Income in this case means provisional income, which includes adjusted gross income plus 1/2 of the Social Security benefits plus any tax-exempt interest. If provisional income is under $32,000 for a married couple, no benefits are subject to tax. If provisional income is between $32,000 and $44,000, up to 50% of a married couple's benefits are subject to tax. If provisional income is over $44,000 a year, up to 85% of the benefits are subject to tax. The thresholds for a single individual are $25,000 and $34,000. In the case of married filing separate and living with a spouse, 85% of Social Security is taxable regardless of the income level. The important thing to remember here is that up to 85% of your Social Security benefits may be subject to tax, depending on how much other income you have. You can minimize taxes on Social Security by lowering your other income, especially investment income. But you should be aware that municipal bond interest, which is usually tax-free, counts as income for the purpose of calculating the tax on Social Security benefits. Here are some other things you can do. Anticipate the required minimum distribution from your IRA, which may cause you to be in a higher tax bracket and may cause some of your Social Security benefits to be taxable. Consider drawing down IRAs before age 70 and a half to reduce those RMDs. Consider converting a traditional IRA to a Roth IRA, which generates tax-free income. Delay Social Security in order to reduce the number of years benefits are subject to tax. Reduce your expenses, pay down debt, and adopt a simpler lifestyle so you can make do with less income. And continue to manage taxes throughout retirement, not just the first few years. As always, please consult your own tax advisor about your individual situation. You have questions and we can help. We've covered a lot of ground today, but you probably still have questions. Those questions might be, what if you want to keep working? What if you've already applied for Social Security? How can you coordinate spousal benefits? And what should you do next? We would be glad to help you consider each of these questions individually and help you come up with a plan for your personal situation. We believe Social Security is too important for guesswork. Let the experienced financial planners at Rooted Planning Group help you protect your nest egg and maximize your income in retirement. Thank you for attending today's presentation, and be sure and watch one of our other presentations about Medicare, generational giving, caregiving, etc. They are all posted to the website. Thank you and have a great day.